Good afternoon, everyone. It's good to see so many proud souls here at the end of the conference. When I talked to Robert about what sort of content to present today, he thought that maybe an overview of what's happening in technology, and we've had some great presentations over the past couple days, and so I sort of look at this sort of like a capstone presentation. As the voiceover, the voice of God, introduced me as a consultant. I am, so please don't hold that against me. You all know what a consultant is, right? Anybody? It's someone who borrows your watch to tell you what time it is. So you laugh, so that's pretty good. So our agenda today, take a quick look, is a little bit about my company. And I had my Rocky Bleier moment back in 2006. Ran into a gentleman named Jeff Green from Laserfiche, and he said, hey, what are you up to? And I said, well, I think I'm about becoming a consultant. He said, well, I need a consultant. And the business was formed, and that was at Laserfiche. And happy to work with a number of organizations here at the conference. We work with them on a number of issues, mostly around marketing strategy, really helping folks navigate the wealth management space, particularly on the independent wealth management side with broker-dealers and independent RIAs. As we all know, it's a very fragmented industry, a lot of nuances. They're not all brokers, so there's a big difference in terms of how people approach the marketplace. Before I was a consultant, spent some time at a couple of organizations you may have heard of, Merrill Lynch, Pierce, Fenner & Smith in the 90s, and then the Charles Schwab Corporation for about 7 or 8 years after that. Again, we work with technology companies, custodians, independent broker-dealers, wealth management platforms, pretty much anyone who's looking to promote their platform to the advisor community. And you also may have read one of my articles once or twice. I do write for Investment News on their technology blog. I also cover RA Biz, the conference scene. So Monday morning, be sure to tune in to rabiz.com, and you can read all about the fun you all had here. And of course, wealthmanagement.com is also one of the folks that we work with, too. So enough about me. Let's jump right into our agenda. Like I said, I think this is like a capstone session, because we're going to cover the broad landscape of how wealth management is changing. I think every presentation that we heard today and yesterday is sort of building up to this. A lot of common themes that I heard that were already in these slides that I produced about a month ago. So definitely, I think we're all on the same page in terms of who's here at the conference. Then talk about one of the biggest issues I think we see really is this adoption. We got all these great tools, and how come advisors aren't using them? And we'll share some stats on that. And then I'll give you a good example of sort of that straight-through processing, that laser app, e-signatures, document management that we've all been talking about today, as well as some to think about going forward. And then if we have any time, happy to take any questions. We got a small group here, so feel free to shout out as we go along. So let's take a look at this. So I call this the PowerPoint chart that launched 1,000 consulting engagements. It may seem simple as we segment the marketplace, but if you look, again, this is the Cerulli data. They've been doing this for a dozen years. The right half of that graph is really the independent side of the world, RIAs and broker-dealers, reps. But what you notice in the bottom left corner, the wirehouses. I used to work there, so I know all about that. They successfully shrunk themselves to greatness. 30 years ago, they had the whole pie. So it talks about change, some dramatic, some slow, some very quick change. All sorts of articles today, even in the Reuters, talking about a lot of wirehouse guys are looking to move independent so they can monetize their book of business when they sell because of tax reasons. So if they get a deferred comp from the wirehouse, they're just going to get capped income tax treatment versus if you sell your business, it's capital gains. And it can be pretty remarkable. So all of a sudden, you're seeing a lot of evolution, a lot of flow. Let's back that up by actual numbers, the assets. We can see two clear winners here and one big loser. Independent RIAs are definitely the fastest growing, up to 2.3 trillion. Duly registered advisors, another trillion, all at the expense pretty much of the wirehouses in the top row. They actually have a negative market share over one of the biggest bull markets over the last 6 years. So definitely some landscape, massive change that's happening in the industry, and we're starting to see it kind of show up in the numbers here. So let's take a look at the other issue that we've talked about a little bit today. Is all about succession planning, sort of the aging of the industry. And here's some fun facts here. The average age of the advisor is about 50, 51. Even more important, the actual advisor who's the owner, they're close to 60. 43 over 55, a third between 55 and 64. And that's a big number there, 2.3 trillion controlled by advisors over 60 years old. So we know that wealth is going to move. Either the advisor is going to sell, transition it, have a succession plan in place. There's going to be a tremendous amount of disruption coming, not so much from technology, but just pure demographics. And there, that last stat you see, over a third of the industry is going to retire in the next 10 years. Yet we do know that only a quarter have a succession plan in place. So again, we've been talking about this for the last 10 years as well, but I think now everyone's 10 years older, the urgency is greater, there's so much more money at stake that this is going to be a big issue, and we'll talk about that in a second. So what are these big trends? So from my perch where I sit, we get to navigate the industry. We come to tons of conferences. We work with about 20 different organizations on their issues and what they're struggling with. And these are the big 6 that I see that we're talking about on a daily basis. The first one really is advisor productivity. That's really what it's all about. A lot of surveys of broker-dealer executives ask, what are you doing? What are you investing for? This always comes up as the number one, and that makes sense. Obviously, you want to be more efficient, grow more assets more quickly. The second one is, I think, really interesting is the ownership of the home screen. Now, everyone's trying to come up with their own sort of middleware. There's TD Ameritrade's dashboard. You've got Advent with their Advent Direct platform. You've got Envestnet buying Tamarack. You've got a lot of activity of people trying to control that home screen so the advisor, when they log in, what do they log into? Is it the CRM? Is it some other operating system? And if you control the operating system, then you control the asset flows in terms of efficiencies and productivity. So this is happening by a number of organizations. Third one is mobile. I love that chart from the DocuSign folks earlier today that showed how from 5 years, the number of people doing business on their phones, signing documents, doing that through a mobile device was almost dramatic. So business is now being done on the mobile platforms, and it's really up to this industry to catch up and take advantage of that. I won't belabor the robo-advisor too much. Deborah Fox has a great new white paper out, How to Defend Against Them. Eric Clark talked about, why doesn't your website have an account opening process? Sort of a pretty, simple questions, but not too many have good answers for it. The next one is next generation wealth views. And by this, I mean being able to show the end client through a portal platform or some other asset aggregation, account aggregation view of where that money is going to the next generation. How do you trace the flow of those assets through trusts and family partnerships and where the big money is going? Having that next generation view will really help cement you as their advisor in front of your current clients' children who are going to inherit all this wealth over time. But this last one, I think I've got some of the more readily detailed stats on is technology adoption. It's amazing this industry spends millions and millions and millions of dollars on platforms, yet there's still a really sharp difference between people who are actually using it. And let's find out why that is. So I don't know if Joel Bruckenstein's in the audience, but these are Joel's stats from his annual survey in Financial Planning Magazine. And here's a quick fun fact. 51% of advisors are not using a CRM. Now, these folks are running billion-dollar platforms. I've been to a number of different user groups, and people who have 6 billion, 10 billion AUM don't have a CRM. Makes you sort of wonder how that could be, but they're still doing it. So it's still very much, automation has not found its way into wealth management. Same thing, financial planning software. Half advisors are not using any software at all. I wonder how they're giving advice. I guess they're just moving along with some sort of a form of being able to work with the clients and come up with ideas. And again, this does open the door to the robo-advisors if the advice that's being given is not generated from a planning platform. Portfolio management, again, 46% of advisors not using software at all. So that's half the industry. That's quite remarkable, and I think that brings up some issues on why that is. I think the bad news is a very fragmented industry. There's lots of different ways of doing business. People have grown it up over time. We still don't have those data standards. I was talking to Ed Beggs earlier today, and he said, the personalities of the players will never allow there to be data standards in this industry. So it'll continue to fragment, causing issues with systems being able to work together. The regulatory environment changes constantly. No one wants to do anything because maybe that's not compliant, or 2 years from now they'll change the rules. There's other one, bull markets. Nothing like a bull market to mask inefficiencies. So advisors can continue to kick along with a inefficient platform because every year they get a 10% raise, 20% raise from the markets. And I think that will become an issue as the bull markets age. Inertia, we all know it's tough to change in that advisor age. But I think on the good news side, the flip side of this coin is that through succession planning, and I'll show you some stats here on what's so compelling about why advisors need to plan and invest, why you all want to help them grow their businesses and have technology because of that issue. I think compliance, once the regulators really pour into this space and say, show me the audit trail for all your activities, and if you just have spreadsheets or filing cabinets, you're not going to be able to do that. That next generation advisor is going to be asking for new technology. They want to work with clients in a different way that they're comfortable with. That fourth one's all about the robo-advisor, and the last one's the leverage power of operational efficiencies. And I think this was what we all say. You know, we do a lot of marketing and strategy. Operational efficiencies is the message, without a doubt. But how do you quantify that? So I want to share some information here on a study that we did with Laserfish on what happens when you deploy technology. And hopefully this could be some slides you can take back to your home office, using your own marketing and compelling advisors to why they want to adopt and change, or why you need to go back to the home office, request budget dollars to be able to fund some of these programs. So here's the economics of a financial advisor. And what I did here is just aggregated all of the benchmarking studies from Moss Adams, Schwab, Fidelity, all of them, rolled them up, and this is what it looks like. If you do a common size approach, you know, direct expense, that's the cost of advisor. So that's whatever you're paying advisors, that's what that bucket is. Gives you gross profit. You subtract out your overhead expenses like rent and admin and back office and all that. And we have an operating profit of 14%. That's pretty much what the industry looks like. This is across different models, sizes, scales, so it's quite interesting. However, when you do look at somebody who has put in a technology deployment, there's the difference. 9% of revenues every year that you get back. So in our view, that information can be very powerful in getting folks to understand why they want to invest and adopt technology. But if you take it to the next step, and the ultimate sort of the end game here, back to our succession planning theme, if you look at what happens when you value these businesses to go to sell them, and you apply a business value multiple that exists in the wealth management space, and you see some dramatic changes in terms of what that business is worth. Spencer hinted at it a little bit in his stuff this morning about the business value impact of technology. Here it is in black and white. So when you apply on, those are revenues, so size of the firm, that left side, 500,000 in revenues, 5x multiple on the increased income, and now you have a 216,000 business value increase. All the way to the right, we're seeing millions. And so this is what the venture capital firms, private equity folks, all those investing in roll-up firms, they know this. They've seen these slides. We take them to New York. They get very excited because we can roll up this industry. That's why there's so much focus on trying to aggregate businesses, put them all under one shelf because they know they can deploy technology and reap the benefits. So that's what's waiting. That's what's waiting for all of us in the room and also in the industry. So I think it's a very compelling message to take back to help coach advisors and management on, you know, what's the arbitrage opportunity with technology. So as part of the study that we did, you know, we don't just ask questions, we actually try to find some answers too. And here's some really good statements that I sort of cherry-picked from executives on what went well. So when they did go to figure out how to do a successful technology deployment, here's some great advice that they learned the hard way. Involve all stakeholders in the process, especially advisors and their staffs. So if they're not part of your requirements team and scoping out the details of what the platform is going to need to use, that's a real missed opportunity because they're the ones who are going to use it. If you get their buy-in up front, it can help short the adoption cycle tremendously. I love the second one, don't touch the software until all processes are mapped out in excruciating detail. So you don't want to have to go back and fix things, find out what is that process, how do you document that, and then go ahead and apply software and technology platforms to make it a reality. Of course, communication is very important, and there's a great point there about having a comprehensive plan for rollout. It's not just, okay, we're done. Now, how do we roll this out? And that goes in the next slide here, where training becomes a huge issue. And this is basically a pretty consistent number that I've heard, that you should spend 30 cents for every dollar that you spend on technology for training. Again, we wonder why people don't use the systems, because they're complex, they're hard, user interface may not be so great, but also no one really, people tend to underestimate what it takes to actually train people and make it work. Having a phased rollout is very important. Don't take on the world, just get one or two things done, maybe a pilot or a branch or whatever, get that involved and get those folks who are the early adopters and celebrate and promote them. Have them up here on stage talking about, here's how we use the system. It used to take us 4 days, now it takes us 4 minutes. And it's compelling, very compelling for everyone to jump on board. And that last one, executive management, they want to know, what's going on? We just spent $10 million on this thing. Where's the results? Where's our outcome? How can we see into it? Because if they don't see the power and the ROI from that, then they have a hesitation to invest even more, and you sort of get into this vicious cycle where they have issues with the fact that they didn't see any benefits on the front slide. So those are some pretty good upfront advice and guidance in terms of folks who have done this for a living. So I want to conclude here with a process example. We all talked through straight-through processing and the ability to automate that new account process. And I think this approach has been seen a number of times. Here's just an example that worked with LaserApp, DocuSign, Laserfiche on, including any CRM. So what is happening here is the CRM is funneling the data to pre-populate the forms in LaserApp. That's then pushed into the Laserfiche repository, so you have a record and a client folder of where that account is. It's automatically pushed out through workflow to be DocuSigned and then sent back into the repository. So you have this straight-through process that happens all at once. It's seamless, no papers generated. It really is quite remarkable. It's sort of that digital transaction management, a new term that I learned today from the DocuSign folks on what that straight-through process is all about, that electronic signature. So that's a lot of data. Went through it very fast. I've got like 2 or 3 minutes here left. Love to take any questions. It's a small group here, late afternoon. So any questions about the data that we showed or any experiences or comments, would love to tee them up. Aaron, what do you have for me? What CRM would you recommend there? Well, I heard Grendel's pretty good. But actually, what we're talking about there really is the fact that you want, whatever you're thinking about, there are so many choices, so many great platforms that you want to have to consider, that whatever you're thinking about, that open architecture is key to doing that. Any other thoughts, questions, comments? Everyone's got a dinner plans tonight, a lot of dine-arounds going on. Okay, thank you very much. Appreciate your attention.